Thank you for joining us this morning. Hopefully everybody can hear me. Yes. If you have any questions as we go through, please drop them in the chat or raise your hand and we'll try our best to answer those. We'll also take questions at the end. The session this morning is being recorded and as I've said, we'll email those out afterwards. The areas that I want to look at this morning is to explain a bit of the background to McCloud for anybody that isn't familiar with it, to run through at a very high level who is affected by McCloud, to describe what has changed, and that's really what has changed to do with the underpin from the first consultation back in 2020 to the more recent consultation in July 23, and then we had regulations made bringing in the new underpin from the 1st of October. I'll explain how the underpin works, talk about who is likely to benefit, what we need employers to do, what members will be doing, and then finally we'll just finish with what NILGOSC is doing. I'm estimating this will probably take about 30 minutes, so it shouldn't be that long a session. So the first thing really is the background. And as probably everyone here knows, when public service pension schemes were reformed in 2015, that changed them from a final salary scheme to a career average scheme. And at the time, there was quite a bit of consultation over the scheme. And it was finally agreed that there would be protection put in place for older members. And in the local government scheme, that was for anybody aged 55 or over on the 31st of March 2012. Since that date, then in 2018, the courts looked at the younger members of the judges and the firefighters' pension schemes and found that they'd been discriminated, or there was age discrimination there. The government then came out at a later date and said they would make changes to all public service pension schemes, including the local government scheme, to remove that discrimination. The regulations then were finally made on the 28th of September by the skin of the department's teeth, and they became operational from the 1st of October. And what we saw with these changes and consultations throughout is that the McCloud Remedy itself changed. So instead of the protection, or not the remedy, the underpin changed. So instead of the underpin being a protection that was just for older members, it's now been extended to be right across all the members in the scheme, providing they're eligible. And not only has it increased the number of members that are eligible, but there have also been some quite significant changes to the underpin itself. If you imagine the underpin is there every time you compare final salary versus care. So it's a bit like, sometimes I think of it like an octopus that has almost got its tendrils into every calculation that we do. And that gives you some idea of how complicated this is going to be to administer. So that's on the background. The most important thing then, who is affected? We've heard an awful lot about the underpin. It doesn't affect everyone. It's only certain people that are eligible for the underpin, and they fall into this list that I've set out in the slide below. And from NILGOSC's perspective, the first thing we'll be looking at is, was the person in our scheme paying into it at some point between the 1st of April 2015 and the 31st of March 22. And that period is really key to the underpin, because that is all that we are really looking at for comparing final salary versus care. So it's known sometimes as the remedy period. We would sometimes refer to it as the underpin period. The next thing, or criteria, is that the member must have been paying into either the LGPS or another UK public service pension scheme at some point before the 1st of April 2012. Now, in our old underpin, that was restricted to paying into the local government pension scheme, so we didn't have to look beyond the local government scheme. And when you hear me maybe talking about the scope of the underpin is increased, this is partly why. Now we're going to have to speak to all the other public service pension schemes if someone has service in them before the 1st of April, and really verify what that service is to be sure that they are eligible for the McCloud Remedy. And it means a much greater data collection exercise for us. The next thing is the person cannot have had a disqualifying break. And what that's saying is they can't have had a break of more than 5 years from the date that they qualified under the pre-1st of April 2012 membership to the date that they started the membership that they're qualifying in the between April 15 and 22 membership. So for example, if somebody, let me see, was in the civil service scheme in 2008 and or left it in 2008, joined the local government scheme in 2018, that's a break of 10 years. So that would be a disqualifying break. And even though they would have service in our scheme between April 15 and 22, they wouldn't be eligible for the underpin. If that person had left the civil service scheme back in 2008 and went to work for another or joined another public service scheme in that period, then you could find that they wouldn't have this continuous break. So that's going to be something that will be quite hard to pick up, and I think will be difficult for members to understand. And the last thing is the person has to have been under their final salary normal retirement age during the period between the 1st of April 15 and the 31st of March 22. In our scheme, or for this McCloud Remedy, what is used as the final salary normal retirement age is what would have been the normal retirement age under the final salary scheme. So it's age 65. So if it's a member and they were 65 before the 1st of April, they're not eligible for the McCloud Remedy at all. If they reached 65 at some point in between the two, then they could be eligible. But if you were 65 before the 1st of April 15, you aren't affected by the McCloud Remedy. So as you can see, it's not straightforward whenever you begin to look at a member to determine whether they're eligible for the McCloud Remedy or not. And some of the information we will have from our own records. In other cases, we won't. We wouldn't know if somebody had been in the civil service scheme before 2012 or the health scheme or the police. And that's what we will need members to tell us. If it's a case where we can tell from our own records, then we won't be asking members for that extra information. Whenever the underpin was first introduced in 2015, it only applied on a per record basis. So if you had somebody that had several records, we would only have been looking at the record. They would only have been eligible in any one record. So they'd have had to meet all the conditions in one record. Now, when the underpin has been expanded, the rules say that the member doesn't have to aggregate or combine their records in order to benefit. So we have to also look across multiple records to determine whether they meet these eligibility rules. So it isn't just one record, it's looking across all the records with us. And if they're not eligible under that, then we're having to look to other public service pension schemes. So it's a bit of a challenge, let's say. So that's the eligibility criteria. What has changed? Again, that's just sort of re-emphasising what I've already said. The member doesn't have to combine their records to be eligible. And we have to look outside the local government scheme to see if they were paying into another scheme before the 1st of April 2012. So assuming we found someone who is eligible, and don't get me wrong, we do have a lot of members that we can already identify as being eligible. We have, I think, over 36,000 people we know are eligible in one record, and we have about 14,000 people that are eligible across multiple records. So that's just within it what we know. And then there would be probably another possibly 40, 50,000 people we may need to write to ask if they've membership in another scheme. So how does it work? The underpin now in this remedy is a two-step process. And the first thing you do is you calculate a provisional underpin. And that happens when somebody leaves the scheme before they take their pension. So it might be somebody leaving employment with you, going to work for someone else, and their benefits in the local government scheme are deferred. So you would calculate a provisional underpin at that point. Or if they keep working right through with you and they're there beyond age 65, you must calculate the provisional underpin at age 65. And that's because under the final salary rules, that would have been their normal retirement age. If you leave early and you take your pension before 65, that would be your provisional underpin date and also your final underpin date. So you could have the two combined. So at the provisional date, we work out what their final salary pension would have been for that remedy period from the 1st of April 15 through to March 22. And we work out their care pension for the same period. The two get compared. If the final salary benefit would have been higher, then that person would be entitled to a provisional underpin. They would have been better off in the final salary scheme. If it's lower, then there's no underpin. Now, I should have maybe said earlier, the local government scheme is unique among the public sector schemes in that it has an underpin. And by virtue of the underpin, it means the member needs to do really nothing by making a choice as to what they get. The rules of our scheme are that we will pay them the higher benefit for that period. So in other public sector schemes, people have to make a choice, and you will hear about a deferred choice. That does not apply to the local government scheme. So we've got this person, they're leaving this scheme before they take their pension or they've hit age 65, and we've worked out their provisional underpin. That's a bit like a marker in the sand. It says they're eligible, and we know from that whether we think they're going to get a guarantee amount or not. When they finally take their pension, and this bit is new, we have to then go back to that provisional underpin figure that say was calculated at 65 and work out and adjust that to what applies now when they're taking their pension benefits. So the final underpin is always at the point you take your benefits. And the reason that we have to do that now is that the underpin includes late retirement increases and early retirement reductions. You also have to include any pension increase that may have applied. So if you've somebody that maybe had a provisional underpin calculated at 65, they're then finally taking their pension at 68, we would have to add in those extra 3 years increases to the final salary bit, and there would be a smaller increase applied to the care bit. So it certainly has complicated the underpin calculations quite a bit. And then whenever you take this into account, you've adjusted this underpin. If what they would have had under the final salary scheme would have been higher, then they get a final guarantee amount, and that is added to their pension and paid out. The member doesn't have to decide whether they want it or not. If the care benefit would have been higher, then there is no underpin applying and they just get the care pension. Okay, hopefully that made sense. To give you, I suppose, a better idea of how this works, and I apologise if you're really familiar with care pensions now and understand it perfectly. The period we're talking about runs from 15 to 22. And under the new care scheme, each year somebody builds up some pension towards their final pension. And in this example, I've assumed that over the 7-year period, the underpin period, this person's pay is going from 27,000 up to 30,000. And I've just, for simplicity, used a £500 increase each year. So you see in the first year, their pay is the 27,000. In the care scheme, you build up a 49th of your pay towards your pension. So 49th of 27,000 is £551. At the end of the year, they get revaluation. Now, some of you may remember back in 2015-16, that was actually a negative figure. So at the end of that year, that person's pension was adjusted downwards very slightly. That balance then became the opening balance for the next year. Pay had gone up, another £561 went in. The total pension built up was 1,111. Revaluation that year was 1%, and they ended the year with 1,122. And so it goes on year. And then you can see in the last year, the increase was 3.1%, giving that person a closing pension of 4,389. So for the purposes of our underpin comparison, we'll be comparing the 4,389 against what they would have built up in the final salary scheme for the same period. And for those who are familiar with the final salary scheme, you use the final year's pay. It really was quite simple now when we look back. So the person has 7 years service. In the final salary scheme, the accrual rate was lower. It was a 60th, not a 49th, times the 37th or the 30,000 gives that person an annual pension of 3,500. So you can see straight away on a very basic comparison between final salary and care, the care pension actually provided a higher benefit, a higher pension. If the person was to end up with the final salary benefits being higher, and I've done a calculation at the bottom, they would have needed a final salary pay of 37,000 instead of the 30,000. So it's about a 25% higher pay in order to get the same level of pension. So from that, you can see you really need quite a significant increase in your final salary pay for it to outweigh the benefits under care. So who is likely to benefit from the McCloud Remedy? It would seem that most members are unlikely to. Very few will have an increase because they will have built up a higher pension in the care scheme than they will in the final salary. We've run very high level calculations across, I think it was about 27,000 members who we know are eligible for the remedy. And our programming isn't complete yet, but our programming was indicating about 400 people of those 27,000 could have an underpin. So it really is a very small number of people. Those who could get an increase, if you've had a significant increase in your pay late in your career, that could result in an underpin. But again, as you've seen from the slide before, you're looking at a pay increase that's more than 25%, probably. If somebody transferred benefits into us, and that would really be a club transfer, so it's a transfer from another public service scheme, and their pay with the local government scheme is much higher than the pay they left the other scheme, then that person, usually on a transfer like that, you get year for year service. So if that person is 7 years in their old scheme on a pay of 30,000 and they've moved for a pay of 50, then they're putting that 7 years on a 50,000 pay. So it's likely they would benefit from an underpin. The next one I'll try and explain in another slide. It's if somebody is taking their pension early and they're getting early retirement reductions and their state pension is over 65, they could get an increase. And it's really because of how there are different early retirement reduction factors applied to final salary from care. But I'll do that in the next slide. The other person that might get an underpin is somebody leaving this scheme and the best of the last 3 years' pay applies to them. For those of you familiar with the final salary scheme, it was always either your pay in the last 12 months of employment or the previous 2 years if that resulted in a higher pay. If you're using an earlier pay, then you're applying pensions increase and that could outweigh the care increase. So those are really the 4 circumstances where we think an increase is more likely. It's certainly not guaranteed. These new regulations came in from the 1st of October. From that point, for anybody going on pension or retiring, we have been doing these underpin calculations, and we've only seen one person who has had an underpin. And that person both had a significant increase in pay. I think their pay had gone from about 30,000 to 60,000 in their last year, where they had moved employment and they had 12 months at the 60,000 pay. And they also fell under the 3rd bullet, where they were taking their pension early and they had a state pension age over 65. So they got an underpin, but there were 2 of those bullet points actually applied to them. And that's the only actual case we've seen so far. In the previous slide, I'd said about the impact of early and late retirement factors. And the key thing to understand here is under the final salary scheme, the normal pension age is 65. So if you went at 64, you had a 1 year's reduction, an early retirement reduction. If you went at 66, you would have had a late retirement increase for 1 year. Whenever the new schemes were introduced in 2015, the CARE scheme, someone's normal pension age became their state pension age. So now we have a range of, if you like, retirement ages, minus 67. In this example, I've assumed we have someone whose state pension age is 66 and they retire at age 65. So when you look at the final salary bit for comparison purposes, that is payable from 65. So that person at age 65 has neither reductions nor increases. They just get their £5,000. For their care element, they would have, I've assumed they've built up 5,200 per year pension. But under the CARE scheme, their normal retirement age is age 66. So if that person takes it at age 65, they're due 1 year of early retirement reductions on their CARE pension. It shouldn't have been paid out until 66. If you're paying it out early, it's going to be reduced. So you compare the two and you apply the early retirement reduction to the CARE element. And this is like the second step in that underpin calculation. For somebody going 1 year early, it's a 5% reduction. If it was me going 2 years early, I'd be getting a 10% reduction. It isn't quite a straight line for the reductions. So you apply a 5% reduction to the £5,200. That's £260 comes off. So you can see that reduces the care pension to 4,940. It now is lower than the person's final salary pension. So that person would get a guaranteed addition. They would have an underpin addition to their pension. Okay, of the difference. Hopefully that explains how these early retirement reductions and late retirement increases interact. Because of that, we will see more people coming within the scope of the underpin. And I think that's quite important to note, is that it isn't just that the underpin has been opened up to everybody who's under 55, but you also have this additional, if you like, interplay between early and late retirement factors that could mean more people will benefit from it. So how many members are eligible? I've already said we've 36,000 members that we know are eligible in one record. For those people, we knew back in 2020 from the consultation that we would need to have to collect hours and service breaks for them for the period from April 15 through to March 22. We went out to all our employers, and I think it maybe took about 18 months to gather all the hours, the historical hours, and those have been put onto member records. As you've seen from the slides that we've already been through, we now need a final salary pay at age 65 for anybody that's worked on beyond 65. So we're going to have to go back to employers and gather that pay. At the moment, we've created a calculator to help employers, and that should be ready to release within the next few weeks. As far as the number of members that we've to collect that retrospective pay, I think it's just under 4,000 members. So the employers with those staff will be getting letters or spreadsheets from us asking for that information. The next group of members are the 14,000 who are eligible when we look across all the records with NILGOSC. Before, under the old underpin, we thought it was only on a per record basis. So we haven't collected the hours and service breaks for these people. And within the next few weeks, we'll be issuing spreadsheets to employers asking for more data on those hour changes over that period. And also for those people, we will need age 65 pays. And then the final group, this is our unknown group, where we don't know how many are eligible because they've been paying into another public service pension scheme. We'll be issuing a newsletter to our employers before Christmas, and under disclosure requirements, whenever regulations change, we've 3 months to tell members. So we're using this newsletter to notify members of the change to the scheme. Those newsletters, when they go out, will be split. One lot will be going to the people who we know are eligible through our own scheme records. The other newsletters will be going to the people where we need to collect further or where we need to collect data on whether they were in another public service pension scheme. So you can sort of see from that in NILGOSC, we're going to have various streams of work running sort of parallel, which is a bit of a logistical exercise or nightmare. For employers then, so what are we going to need? For the hours and service breaks, we need those for any periods worked from April 15 through to March 22. Hopefully we've already now gathered more than half of those, but there will be that further data collection. We'll forward the spreadsheets to employers within the next few weeks. And we've asked employers through the last 2 circulars to give us contact details to send those spreadsheets to. And that's really for data protection purposes, so that we're sure we're sending that member data to exactly who should be receiving it within your employer. If you haven't provided those details so far, then please do send them in to us as quickly as possible, as we can't send those spreadsheets out until we've had a contact. With regards to the age 65 pays, the pay that we need to collect is either for the 12 months to age 65 or the best of the last 3 years. So you'll need to be looking at whether their pay in the 12 months to 65 was higher than the previous 2 years. If it was, that's the pay you give us. If there was a pay in the previous 2 years is higher, then you need to go back and use that. At the moment, we can tell that around 4,000 of our members, active members, have already reached age 65. So we need those pays. I've said we've that calculator that's been tested. Hopefully that will help a bit. For any employers that are already familiar with calculating final salary pay, it's just the same calculation. If you're already on iConnect, when we switch this on, you will get messages that you have so many staff or members that you need to submit an age 65 pay for, and you will keep getting that reminder until you do so. You can submit it through iConnect, so you don't need to complete and return the spreadsheet. For the employers that aren't in iConnect, they will need to return the spreadsheet to us. And again, we've asked for contact details for those. Not quite sure why I put 2 different dates. You have until the 30th of November to do that. If you can do it sooner, please do. So that's the data we need from employers. The next question then is, do members need to do anything? Well, as I've explained already, in the Underpin and the LGPS, members have no choice to make. They will be paid whatever is the higher value. So for the majority of members, where we can tell from our records that they're eligible, they don't need to do anything. You will be giving us the hours, the age 65 pay if that applies, and we'll be doing the calculation, and the member will be getting paid whatever is due to them. Now, under the new Underpin, there's not even a requirement for members to need to combine records to benefit from it. So again, they don't have to do anything there. The ones who will need to do something is those members who we can't tell if they're eligible or not, but they might have membership in another public service pension scheme. And we'll be issuing that newsletter before Christmas, and we'll be asking them and giving them a form or a link to a form where they can complete their pre-2012 membership and let us know about it. And that will then let us mark their record as being eligible for the McCloud Remedy. We've updated, or not even updated, we've created completely new pages on our website. The links are there, and there's extensive FAQs. And those FAQs cover everything. What if I retired in ill health retirement? What if I trivially commuted my benefits? What if I've left and transferred benefits out? So as you can see from that, you know, the problem with this remedy is we're looking backwards, and we're looking back now for what, 8 years? And it's very, very difficult to go back and try and fix records. We have people in that period who will have been eligible, will have died. If the underpin applied to them, we're going to have to work that out. We'll have to contact their survivor, and we may have to pay revised survivor benefits. From the information we have at the moment, we're going to have to review 50,000 records. So it's a mammoth task for NILGOSC. But from the members' side, the good news is, they really have very little to do within our scheme. Probably covered this slide in advance, got carried away. What is NILGOSC doing? We're obviously covered collecting the data. From the 1st of October, we'll begin reviewing over the 50,000 member records. For all of our calculations, we rely on government actuary guidance. So whether it's early retirement, late retirement, flexible retirement, there are quite significant changes because of the underpin to flexible retirement. I'm not going into that in detail here. It is covered in the FAQs on the website. At this point in time, we have no guidance with regards to the underpin. I understand we should get the first batch of government actuary guidance towards the end of November. Our software providers have been absolutely fantastic. They've been programming for McCloud for about the last 2 years. A lot of the programming that they've been doing has had switches in it. So if this happened, they would turn this on, or if something else happened, they would turn something else on. What was never programmed for was members not having to aggregate their benefits. So at this point for us, that's all manual, it's all separate exercises in reporting and trying to identify these people. We expect we will get guidance from the department on a priority order for the cases to review. I believe that priority order is that any cases that we're paying out now, we should be doing them in line with the remedy and including it. And that's what we're doing. From the 1st of October, we've been doing that as best we can. I then expect the priority cases will be pensions and payment that need reviewed. So those might be ill health pensions and deaths. Some of the deaths will be particularly difficult to review because it can be very, very difficult to contact survivors, or if it's an amendment to a death grant, to actually find recipients for that. I expect remedying this will take years. This is not going to be a quick, we'll have it all done by March next year. There's absolutely no way. I think going back to employers, we will be going back and asking for data over and over again. By contacting all the people where we don't know if they've had other public service pension membership before the 1st of April 2012, we're going out to try and gather that in one fell swoop. I know not all members that have that membership will reply to that. So we will still be having to go back and collect hours and service from employers, I would expect, for years to come. On that basis, I would ask that employers do retain their records relating to members' service so that you know when our changes happened within that period from the 1st of April 15 through to March 22. Please do not destroy those records. So we'll be reviewing pensions and payment. We will do that as soon as possible, and we expect that to be sort of the main priority. For anyone whose pension will increase, we will contact them. People don't need to contact us. If their pension needs revised, we'll let them know, and we'll let them know if we need more information. If their pension should now have an underpin, we will have to work out their arrears. There will be interest payable on that. The interest payable is at a different rate than would have been payable under our normal scheme regulations. I have a feeling it's possibly at 8%. Normally we pay base +1. So, for any of these cases that will need rectified, and there's arrears of pension, there's interest, some of these people may have paid tax charges based, or may have paid a tax charge because of their pension savings, which may now appear to be too low. Some of that will need to be recalculated. On a positive side, I guess which depends on which way you look at it. We only expect there will be a few cases where any pensions and payment will increase. As time goes by, possibly you will see more people coming within scope. So that really summarises what we're doing. I think I've covered most of what I wanted to cover. Has anybody any questions? I've maybe bamboozled everyone.
Stunned silence.
I think we're just feeling your pain.
Yeah, we added 3 extra staff, full-time staff, to deal with just the previous collection of hours and service. At this point, I don't know if those 3 will be enough going forward, or we'll have to up our staffing complement. Retrospective calculations are phenomenally difficult, and no matter how good our software is, you end up with manual calculations. So, we may find if there are a lot more of these, we'll need more staff. For employers, when we send those requests out for our service breaks and age 65 pays, it's a plea to respond to us as quickly as possible. It is really important that we get those records up to date. Many of you will be aware that we are a party to claims made in the Industrial Tribunal. And at the moment, I think there's 126 of our employers involved in that. But a lot of this information on hours and service breaks may actually be critical to working out whether working out someone's benefits and whether the underpin applies to them. So not only will we need that information for the purpose of the remedy, we may also need it to make sure our records are up to date for the purposes of the tribunal cases. But I really can't comment on them any further, as we're obviously a party to those.
Zena, there was a question there came in from Carmel. How accurate are the calculators on the NILGOSC membership website?
Okay.
Is that MSS or my NILGOSC pension online?
Carmel, I'm guessing it is the My NILGOSC pension online with the member portal. At this point, the programming on the member portal has not been changed for McCloud, so it doesn't take account of this remedy at all. Our programming internally, where we are individually doing calculations when people retire to include McCloud. At the minute, because of errors, and this really is so complicated, because of errors in programming, we haven't been able to do it in our live system as a bulk update. I expect we have further software and test at the minute. We've tested that most of those errors appear to be cleared, and we're hoping that we will be able to do the bulk calculations within probably a month. Sorry, was that another question? No. So no, unfortunately for the members, what they will see in My NILGOSC pension online will not include the McCloud remedy. As far as benefit statements go, I don't know what our instructions are going to be. It's not covered in the regulations that have been made. My preference, because as you've seen from that, an underpin, whether somebody is entitled to an underpin will fluctuate from year to year, depending on their pay and the value of their care benefits. Whether it will be possible to have something on a benefit statement that just says you're protected by the McCloud Remedy, or whether we will have to show an underpin amount each year that will go up and down. I honestly don't know at the minute. I think the department is due to have another consultation on benefit statements and what will actually be provided. So we'll just have to wait on that. Even with that, if benefit statements were to be amended to include it, I wouldn't expect to see that until maybe the statement's gone out in August 25, because there has to be time to give us a fair chance to amend records. Anything else? No. Okay. Well, if anybody has any queries, Ruth and I are happy to take emails on those. The email address on that slide is the general email address for NILGOSC, but if you just put McCloud query or McCloud Remedy query in the line, it'll come through to us. Hopefully that has helped explain the remedy, why there's more data collection exercises for employers, and thank you for your time this morning.